Hi, I'm Aoife Devitt, and welcome to 50Faces TV. Today, we are joined by Tom Majewski, who is Managing Partner of Eagle Point Credit Management. Tom previously featured as a guest on this podcast in 2021. Welcome, Tom. Great to see you here.
Aoife, great. It's great to be back. It was a couple of years ago, I think, maybe 2021 we did this the first time.
Well, quite a bit has changed since we first interviewed you on this podcast, and the private credit industry is now topping $3 trillion. Can you paint a picture for us as to this current state of the industry in terms of any potential crowding, innovation, new strategies, or the credit quality of the issuers?
Definitely a maturing market would be the first thing I would say. The private credit market in the old days would have been called middle market. The definition, the name has certainly changed, and even the definition in that some private credit in transactions can exceed $1 billion at this point. Certainly not middle market by my book, but something that's matured and expanded to touch a lot of different parts of the market. I think it's been a very positive thing for the market overall as well. When we think of a typical private credit borrower, they're going to be a below investment grade company, probably with a manufacturing operation or a retail operation or maybe a service business. For many of the U.S. private credit funds, they're going to be companies based in the United States, although there's plenty of private credit opportunities in Asia, in Europe for sure, and to a lesser degree in Asia, where the market is not yet as developed. These are companies that make things and do things and create jobs every single day. One of two of the things perhaps that I would say are amongst the best aspects of the private credit market are first that private credit assets in general are held in very stable or sticky hands. And while there's probably a little bit of excess competition and perhaps pricing is a little through fair value, as many fund managers have raised billions and trillions in aggregate dollars to lend to this space, they're typically private equity style funds or permanent capital vehicles like BDCs, and vehicles that have a steady hand and that can see a credit through to the ultimate outcome. By and large, the loans that are being made in the market, even if they're a little tight by level, are held by steady hands, and they can see a name through to the ultimate outcome, which may include default in a few cases, but certainly the vast majority we expect to ultimately pay off at par. At the same time, I think private credit provides an important buffer in a company's growth, evolution, or decline, frankly. And there's a number of examples of situations where the private credit market has refinanced out companies that had been in the syndicated loan market for the large cap, still below investment grade, but large cap loans. And what that provides is, in some cases, a company that maybe is changing their strategy, changing their customer mix. They need to be able to perhaps work out their finances for a period of time. They're still profitable, but maybe not as profitable as expected, and get to the spot where they need to be, but maybe do it without the risk of hostile, distressed funds buying up their debt and trying to collapse the company or take it over unto itself. While private credit, in many cases, has a number of lenders, typically they're all getting in at the same starting point, and there's not a lot of secondary dealing in those loans. So if everyone has the same starting point in a loan, they probably have the same view as to what the best outcome would be. And that compares very distinctly to the syndicated loan market, which is also a trillion plus, almost $2 trillion market in the United States alone, but where many investors can have different starting points. If you bought the new loan at 99.5 when it was issued, you really want to get par back. If you bought that loan at 50 cents on the dollar in the distressed market, 75 is a great outcome. That's a 50% gain, 25% loss for the other investor. So it's a little bit tricky. And one of the things that's nice about private credit is if a company is having trouble, it gives them a more private, a little more stable time to work things out. It's important to remember, very few companies would optionally go to the private credit market, and that by and large, the syndicated loan market has a lower interest rate, lower spread over SOFR. But in many cases, that private credit market provides an important buffer between facing really predatory lenders, but also not maybe for companies ready for staying in the prime time of the big leagues of the syndicated loan market. So it's a positive evolution. There's been some talk of bubble and things like that. Anytime you hear multiple trillions of dollars in something new, you've got to ask the question, and that's a very fair question to ask. Often what makes bubbles burst is when they're held in short-term hands or unstable hands. And even if my prediction is right that perhaps there will be some defaults in the private credit world, I still think most investors will have a positive return, but maybe not as positive as they were expecting.
That's a really interesting analysis of the state of private credit. When you mention the alignment of interests in terms of how long term the holders tend to be, and equally the importance of this segment of the fabric to add some stability to the corporate infrastructure, that's certainly an evolution since the days of shadow banking. And CLOs have been thought of as somewhat complex instruments. How do you think the client's level of understanding of CLO instruments has evolved?
So when we set up Eagle Point in 2012, 9 out of 10 people that we called wouldn't even take our call. That sounds a lot like CDOs and no, thank you. I don't think the committee is going to be interested. I don't think the trustees are going to be interested. I'm pleased to report that's probably only 7 out of 10 people won't take our call now, which suggests a threefold increase of people who will take our call. And what that's underpinned by is performance. And we saw how CLOs performed through the financial crisis. 96% of all CLOs issued prior to the financial crisis had a positive return to the equity class, despite unprecedented levels of corporate defaults. And in fact, the median IRR to equity was around 15% of all the pre-crisis CLOs issued, over 500 different CLOs. A number of people in the 20 teens said, oh, that was a lucky break. It was a one-time deal. That'll never happen again. Well, we had COVID happen, and indeed, the price of loans fell precipitously. I think loans were down even more than stocks in March of 2020, odd as that sounds. But if you were an investor in a 2019 vintage CLO, you've probably had a very good experience overall in that the CLO structure performed just as it did in 2007, 8, and 9. It worked. There were no forced liquidations. CLOs proved to be a very steady hand, and the ability to reinvest, particularly in dark days, proved to be extraordinarily valuable. And across all CLO collateral managers, these are very smart, sophisticated, experienced individuals. Everyone made a credit mistake going into COVID. No one called that perfectly. But if you were managing a CLO that was still in the reinvestment period, one of the things that's misunderstood or underappreciated is the rate of prepayments on loans. And in the month of April 2020, just one single month, roughly 2% of all syndicated loans paid off at par. Now, these were certainly not optional rate and term refis. No CFO turned up to the CEO and said, hey, why don't we refinance our debt today? Previously announced M&A, mandatory amortization payments, maybe a few maturities, whatever it may be. If you were running a CLO in those dark days, you probably weren't at the office, you were at home, but you got 2% of your money back at par in a market where many loans are trading at 75 to 80 cents on the dollar. This is before making relative value decisions. This is simply the opening the mail school of portfolio management. You got your money back at 100 when things are on sale at 75 or 80. And that went a long way to make up for mistakes that you might have made going into COVID in a scenario that few would have predicted. And what that's done is it's really helped investors. We've made it through, as an asset class, yet another pretty significant battle. And no CLO liquidated during COVID. No one had a forced liquidation or things like that. When you hear about the leverage in CLOs, which is typically 10 times, frankly, many people say that's very, very risky. But well, leverage obviously can enhance returns in good markets. In my opinion, the principal risk is it might make you do something on a day you don't want to do it or can't do it. Either sell assets or put in more money. Kind of like margin financing. If you had margin to stocks, you might have had to put money into your brokerage account or be sold out. CLOs don't have any of those provisions in that the financing is non-mark to market. And so not a single CLO had a forcible liquidation despite the price of loans falling significantly, as many assets did during that difficult time. So we've got another battle or another, victory in the face of credit adversity. And I think that's really helped investors understand the why. And while some of the optics around the leverage and that the assets in many cases are rated below investment grade may weigh on folks and still continues to present the persistence of the opportunity for sure, the data continues to stack up in favor of this is a very good long-term investment.
And clearly, we've been hearing a lot about interest rates in the current cycle, the Fed policy regarding them, whether we're in a rate hiking cycle or a rate lowering cycle. How would you say that interest rates affect this strategy?
Yeah, that's a great question, Ethan. The impact of interest rates has been both significant and minimal all in once, and I'll share both of those perspectives. And I'll make a direct comparison, particularly to commercial real estate, where I think the pain has been much greater and is still not yet resolved, frankly. Across most loans, essentially all loans and CLOs are floating rate. They used to float off of LIBOR, now they float off of SOFR, and CLO debt by and large floats off of SOFR as well. So your assets and liabilities, the base rate is substantially matched. There might be some tiny day count basis, but you're matched on your base rates. And in 2021, interest rates were 0 or 1%. And if you were paying SOFR plus 400, you paid 5% interest. Now SOFR is, several times higher than that, perhaps 4%, give or take. And your spread, even if it's around 400, now all of a sudden you're paying 8% interest. It's a big increase for sure. But what people forget is when companies are underwritten and when the rating agencies rate companies and when banks and collateral managers underwrite loans, they're typically underwriting a company with 3 to 4 times interest coverage ratio. So in that case, where interest almost doubled, you still had a lot of margin of safety in terms of companies' ability to service their debt. And then B, many companies were able to pass on the high inflationary costs that they were facing through to their customers. There's not a lot of businesses, there's a few, but not many where you're facing cost pressure, but you can't also then pass that higher cost through to your competitor. And the average below investment grade company had their earnings increase, their EBITDA increase by over 10% over the two plus years after COVID. And that also goes a long way to help pay your interest cost. Now, the flip side, if you look at commercial real estate, if you look at an office building like the one I'm standing in or the one that you may be in right now, when that loan, if that building has a mortgage, it might have been underwritten at a 1.4 times debt service coverage ratio. Very different than 3 to 4 times. And while I'm sure many of the tenants like us continue to pay our rent, and I'm sure you're paying your rent, at some point, that mortgage is going to be up for renewal, and it will have a 5-year maturity or something like that. And while rents go up a little bit every year, they often don't go up enough to cover that significant increase in interest cost. And so while the default rate for corporate borrowers, even the levered below investment grade corporate borrowers in the CLO market, remains quite low, we're hearing many situations where office buildings are trading at 50 cents on the dollar or worse compared to pre-COVID levels. Some of the buildings are becoming obsolete for sure, as fancier, newer, prettier buildings with amenities and green walls and whatnot come into place. But just the raw math of if you were borrowing at a rate and you only had 1.4 times coverage or 1.5 times coverage, the increase in interest rates has really hurt. So it's not been a big factor in the CLO market for the performance of CLOs. What it has made more interesting, frankly, is CLO debt. And whereas when base rates were less than 1%, the all-in returns on CLO debt weren't that exciting. They were good on a relative basis relative to buying fixed rate bonds. And you certainly, in 2021, had you bought a fixed rate single A or a floating rate CLO double A, you would have been much happier with your floater than your fixed. With base rates where they are, all of a sudden, CLO debt, frankly, presents investment opportunities that can equal pensions and insurance companies' long-term actuarial assumptions, which they couldn't do in that low rate environment. So it's not been a big issue, really a substantive issue at all. And it's actually created a new opportunity for investors who might be seeking to get their long-term actuarial rates, but doing it in credit product.
And to close us out, besides CLO debt that you mentioned there as being an interesting opportunity, what other opportunities do you see today that excite you?
Sure. One of the things that we're most excited about, and a lot of what we do at Eagle Point involves investing in CLO equity, the opportunity to unlock value in CLO equity or create value through being a majority investor today is tremendous. And some of the rights we have as a majority investor, and these are protective rights that an investor might have, but the opportunity to either call a CLO or more interestingly, reset a CLO And what resetting a CLO means is you keep your same assets. You might have 150 or 200 assets. You're very happy with those loans. Pay off the old CLO debt, pay them back at par plus accrued interest, and then issue new CLO debt at much tighter spreads. If we were talking 2 years ago, I would have told you AAAs were around SOFR plus 200. They're getting very close to SOFR plus 100 today. So if you issued a CLO in early 2023, you're probably counting the days until that non-call period ends. CLOs typically have 2-year non-call periods. And that debt that's at seemingly usurious levels by today's standards is freely callable by the equity. Last year, as a firm, we reset dozens and dozens of CLOs across our different portfolios. And this is going in and ripping out costs on the right side of the balance sheet, which inure to permanent value to the equity. It takes time and effort to do, and the market has to be there. The market could stop tomorrow, so it's never a sure thing. But one of the best ways to create value today, frankly, is taking a CLO that's probably halfway through its non-call period, maybe 2/3 of the way through. You can see 6 months out, you're going to be able to do a reset, maybe take a lot of costs out, maybe even take a dividend to the equity class. It takes a lot of work. It doesn't just happen automatically, but it's a way to create very real value today. And I think it's misappreciated in the market.
Well, thank you so much, Tom. You have the ability always to make the complex clear. And certainly doing the work and doing the hard yards is something I've always associated with Eagle Point. Thank you so much for coming here, for demystifying this sometimes complex area, and for sharing your insights with us.
Great. Thanks so much for having me today, Ethan.
I'm Ethan Devitt. Thank you for listening to 50 Faces TV. You can follow us on YouTube and all of our podcasts on regular podcast channels.